The next session brings together leaders from ministries of finance, central banks, financial market authorities, and the UN to discuss national and regional developments in policy and regulation for accelerating sustainable finance. So I'd like to introduce on stage the panel being moderated by Laura Canas da Costa, Global Policy Co-Lead at UNEP FI. So Laura, would you like to come up on stage? And Laura will introduce the panelists, but I'd like to highlight that we have representatives from India, Switzerland, Europe, as well as global representatives as well. Laura, over to you.
Good morning, everyone. I hope everyone's well rested and well caffeinated, even though, of course, there's no better way to start the day than talking about policy and regulation. I'm extremely pleased to kick off day 2 with such an amazing group of panelists. So I have with me this morning Geetu, Joshi, who's an advisor at the Indian Ministry of Finance. We have Krishnan Sharma, who's a principal economic advisor at DESA, joined by a central banker, Irene Heemskerk, who's the head of the climate change unit at the European Central Bank, Helena Viñes Fiestas, who wears multiple hats as the co-chair of the Net Zero Policy Taskforce and also chair of the EU Platform on Sustainable Finance. And finally, Philippe, Lionnet, who is the Sustainable Finance Envoy at the Swiss State Secretariat of International Finance. So we have not that much time and a big panel, so let's kick off. So we heard a lot yesterday throughout the day, of course, about voluntary initiatives and industry leadership being so important in advancing sustainable finance. And we want to shift gears a little bit and explore the role of sustainable finance policy and regulation, which I think is very much the scaffolding that needs to underlie this ambition to provide clarity, to provide consistency and accountability. And at the same time, we also heard throughout the day yesterday that I think many in this room, many of UNEP FI's members are a little bit daunted by this rapid acceleration, not just in the breadth of sustainable finance policy, but also in the depth, right? And the numbers are staggering. We heard at the closing panel yesterday that 60+ jurisdictions are developing taxonomies. In the Net Zero Task Force report launched at COP, we hear that all G20 countries now have some form of corporate or financial regulation to support sustainable finance. And we see a rapid acceleration. So, of course, this is causing not just implementation challenges, but also regulatory fatigue in many regions. And what we really want to do this morning is to take stock on how policy and regulation can support the sustainable finance ambition, what the role specifically of central banks is, how this plays out in Europe versus in emerging markets, and ultimately how we can ensure local approaches and interoperability as well as usability overall with the goal to make sure that regulation really can fulfill its role as being an enabler rather than a barrier. So with that, I want to turn to you, Geetu, and to Krishnan. So as leaders in your respective institutions, I wondered if you could just give us a snapshot on the role that policy and regulation plays in supporting sustainable finance. And yeah, what's on your agenda at the moment?
Thank you, Laura. A very good morning to everyone. A pleasure to be here with all of you this morning. I'll actually be speaking on the government perspective on this subject, which is a very important subject on taking stock of the policy and regulations in place across the globe on financing sustainable development. To begin with, I'll just like to start with the fact that, as all of us are aware, an enabling policy environment is essential for diverting or aligning financial resources to our climate and sustainability goals. And I'll be briefly talking about India's role in reaching our sustainability goals. So India has made sustainable development central to its development agenda, and we are focusing on all three dimensions: social, economic, and environmental. While the focus today, or the focus of this roundtable, has been more on environmental, but I do feel that financing for development has also taken a prominence today with the 4th International Conference on Financing for Development coming up in Spain in 2025. So it's very important that we take different measures for reaching our goals. Coming to India's climate ambitions, we have reflected these in the NDCs and also with the announcement of net zero emissions by 2070. And we have undertaken several policy initiatives as well as regulatory initiatives for driving finance towards our sustainability goals. I'll in fact just mention a few of the policies. We are in the process of developing a climate taxonomy, which has been announced in the recent budget this year. And we also have other policies such as priority sector lending, which gives focus or has prioritized renewable energy projects as a priority sector for getting access to affordable finance. We have measures like the Perform, Achieve and Trade scheme, which is more on the energy efficiency, to encourage energy efficiency and reduce in energy intensity or the energy consumption. We have the PAT scheme, which is implemented by the Bureau of Energy Efficiency. Coming to regulatory aspects, we have several financial instruments which have come up. The SEBI, which is India's capital market regulator, introduced the Green Debt Securities Framework in 2017. And we also have our central bank, the Reserve Bank of India, issuing a sovereign green bonds framework, which sets out principles for categorizing a project as a green project. And therefore, we are able to raise funds for green projects in this way. In 2023, the RBI has also issued a green deposits framework to encourage regulated entities to offer green deposit products that boost funding for green projects. And we also have introduced a carbon credit trading scheme, which is a market-based mechanism to reduce or limit emissions by allowing trading of carbon credits. Coming to disclosures and reporting, we have the business responsibility and sustainability reporting, and India was one of the first early adopters of the sustainability reporting standards, by which ESG disclosures are mandated by the top 1,000 listed companies. We've also got a recently introduced regulatory framework for ESG rating providers, which marks a significant milestone to ensure standardized ESG ratings for informed decision making. I think I'll stop at that and we'll continue discussions. There's a lot that is happening in India and across the world, and I'm sure all these initiatives will definitely lead to attracting international investments and will support the green transitions and ensure long-term economic resilience. Thank you.
Thank you so much. That's quite an impressive list of developments. Krishnan, maybe zooming out a little bit, you have a really good perspective working in a number of developing and emerging economies. How does this reflect what you see in terms of the role of regulation in attracting green finance?
Thank you very much, Laura. And good morning to everyone, and thanks for the invitation to be on this panel. So in the Financing for Sustainable Development Office of UN DESA, right now sort of policy and regulation assumes an extremely important role, especially in our preparations for the 4th International Conference on Financing for Development. Broadly, I mean, you know, we see it in as much as it influences the scaling up of finance and investment for sustainable development, for the SDGs, and also ways in which it influences the impact, especially of private finance on sustainable development. So there are like 4 or 5 broad areas in which it has a great influence. The first is the issue of prudential regulation. Now, prudential regulation has been set for purposes of financial stability, but there are concerns that there are ways in which it may inadvertently sort of, you know, have unintended consequences that limit the supply, the provision of sustainable finance for development. I mean, in particular, I mean, you know, a lot of the prudential regulatory frameworks have been calibrated for large cross-border financial institutions based in developed countries. And there has been discussion, I mean, and we have an open mind to it as to whether this may perhaps, I mean, you know, limit the provision of sustainable finance within and investment within developing countries, whether it may limit the provision of finance to small and medium enterprises, whether it may limit the provision of finance to infrastructure. There's a whole sort of range of discussions going on. We had a major expert group meeting on this. I mean, you know, and the conclusion that we're coming to is that, you know, this is an area that is ripe for further discussion. It's important to have an open mind to it because, again, bearing in mind that the primary goal of prudential regulations is to ensure financial stability, and this should not be compromised in any way. The issue is, can there sometimes be an inadvertent mispricing of risks? So we have recommended setting up a study group involving both, especially involving regulators, academic experts, private actors, to really explore this issue further. So that's one major sort of issue that we're looking at, I mean, with a view to the conference. The second one really looks at the issue of, I mean, you know, incorporating sustainability considerations into regulatory frameworks. I mean, there is ample evidence that, you know, risks related to ESG are systemically significant. Yet, I mean, you know, I mean, while there has been efforts to incorporate them, I mean, in certain countries, it hasn't been the case in other countries. And what is very important is to have some degree of global harmonization and agreement on this, basically, you know, so that, you know, these are, I mean, to the degree that these are incorporated, they need to be done in a globally harmonized manner and coordinated. So there's a level playing field. That's the second factor. The third related factor is new innovative mechanisms such as blended finance. They play an important role. I mean, you know, in terms of de-risking, they can play, and sometimes de-risking investments on the balance sheet of financial institutions. Now, it's important to consider. Should they be considered in terms of prudential regulatory frameworks? Should their effect on balance sheets be taken into account? So this is a whole new area which requires further consideration. The fourth area relates to credit rating agencies. I mean, you know, insofar as regulation is sort of locked in on credit rating agencies, and sometimes, you know, when there's a clear line that, you know, relating to investable and non-investable securities. And then once again, there's a strong justification for this. Can this sometimes lead to cliff effects and instabilities? And if so, what can be done there? And finally, I mean, you know, there's the issue of regulation in terms of encouraging short-termism. I mean, quarterly reporting, the requirement that asset owners need to price their assets to markets. I mean, you know, can this inadvertently influence short-termism, in fact, you know, by market actors? So these are broad areas. And of course, linked with this is the whole area of sustainable finance, disclosure, including should it be mandatory and so forth. So these are the broad areas that we're considering with a view to the conference. Thank you.
Thanks. You've given us a lot to follow up on there. And we definitely want to circle back to your point about harmonization. But let's maybe stay with prudential regulation and central banks for a moment then. So you've already said this in a nutshell as well, but what Frank Alderson from DNB has said is that if climate and nature-related risks are a source of financial risk, they fall squarely within the mandates of central banks, and we're lucky to have a central banker here today. So, Irene, how does ECB envision the role of prudential regulation evolving over time to support the green agenda? And I'd be especially interested to hear whether there are any specific adjustments you think we should be making from a European perspective.
Thank you so much, and a pleasure to be here with you in this pretty impressive room, I have to say. I like the quote you said from the speech, because I think Frank Alderson has been saying this for years. Climate change, nature degradation affect the economy, and they lead to financial risk, and therefore they fall squarely within our mandate. There are a few more words that quote as well. That means that, because what is our mandate? That is preserve price stability and ensure the safety and soundness of banks. And this is what we've been doing very diligently since 2020. I think a lot of you are familiar with our guide for supervisors for banks to manage climate-related and environmental risk. We issued this in 2020. Sets out what you do on your business strategy, your business model, your risk assessment, your disclosures, so all the elements. So really making sure that if you're a bank, that if you decide in your boardroom on your strategy, you also take these kind of risks into account. If you issue a loan and somebody comes up to you for a mortgage, you think about climate and environmental related risks. So really putting it in the organization on your risk management. So since 2020, we've been really diligently following up with the banks, where are you standing? And by the end of this year, and there are not so many days left, as you know, we expect all banks to fully comply with our supervisory expectations. And we also announced that we won't shy away of issuing periodic penalty payments if they don't do this. So this is all coming from a risk perspective, and I think it's a really important one. At the same time that we issued these guidance, and over the years we've looked and we issued good practices, and this also shows what can be done. I think this whole package really helps to banks to navigate the transition and navigate the physical risks. But if you look into like what is it, can we like, we're really coming from a risk perspective, and what can you do to contribute to the transition? Well, it's first of all, it's for policymakers to set the boundaries there and set the rules. But I want to highlight a few things, because as you may know, that the European Commission has put out over the past 5 years a very impressive sustainable finance framework. Really worked hard to get the taxonomy out, to get the disclosure requirement out, the prudential requirements, green bond standards. It's a full package. They've been working really hard over the past 5 years to get that there. We're here now, and I think one specific element I want to highlight, and that's the transition plans requirement for banks, so that they really implement plans with quantifiable targets and with intermediate milestones, how you get to 2050. It's still from a risk perspective, but still getting that in place, having banks to think about, okay, what is actually the target for the transition? And also, I think we should look into nature and physical risks and adaptation requirements there. But this package, and having your customer engagement on this, okay, you're here now with your emissions, how will you reduce going forward? So I think this is one important element that will really contribute. Having said that, the financial sector can still be as green as the real economy. So we shouldn't we should include also like what are the regulatory requirements being put in place for the real economy? What is it? Will there be a carbon tax? Still, like, how do you really properly price it? Will there be a more sectoral pathways? There were some discussions on like the phase out of diesel cars at some point. If you are a bank now and you're getting a request for a loan for a car manufacturing, are you still providing it if it's not taking into account electrification? Like all those kind of things, I think this really helps. And then lastly, like for the risks, last point I want to make, for the risk, often people think it's still far away and it's still to come. There was a great article in the Financial Times recently on the price of coffee. The commodity prices have gone really up, highly up, due mainly to bad weather, caused by climate change, more extreme weather. And the other part was the announcement of the EU to put the deforestation regulation in place. That means that any commodity that will be traded with the EU needs to have clarity that it didn't harm any deforestation. So the commodity traders were already advancing on this, this regulation being put in place. So with that, like, you already see the prices now, and I want to say that, like, this real economy regulation will help banks to better price the risks. Thanks.
Thanks, yes, and very well understood your point about real economy. Helena, you had a not very small role to play in the EU framework that Irene mentioned, but I would like to actually ask you, as your role co-chairing the Net Zero Policy Taskforce, so you looked at a range of policies and where we stand, and so yeah, are we on track with regards to policy tools? What are areas of progress? But actually more interesting perhaps is where are we falling short, and where do we need to see more developments happen?
Thank you so much, and good morning to everyone. I actually wanted to thank you not only for inviting me to this panel, but also for the role UNEP FI has played in the task force, and also the NGFS and Irene in particular. So thank you so much for that. So basically what we did, I think it's important to start very briefly to explain you what we did. What we did is we analyzed more than 1,000 policy instruments across the G20. These are policies that they are specifically targeting large corporations and financial institutions. And what it came out, and you mentioned it in your introductory remarks, was that policy development in this area is much more widely spread than we thought. You know, that is not exclusively confined to developed countries or to the EU, as it is often, you know, thought about, but it's also that emerging markets are also helping to lead the way. What we saw is that all G20 countries have some form of policy targeting the transition of non-state actors. This is how we call the large corporates and the financial institutions, and that in fact, since 2020, this type of policies have tripled. Yeah. Now, when you start looking at the details, you see that these policies take very different types of forms, right? But let me highlight 3 types. Number one, disclosures. This is no surprise to anyone. But what is interesting is that not only we're moving from voluntary disclosures to mandatory, but also from backward-looking type of indicators to forward-looking. And not only is transparency becoming mandatory, but criteria attached to how you report. So it's not any longer sufficient to say what are your targets. They're telling you how you need to set the targets, what you need to include, you know, such as Scope 3. So very interesting development in that area. Secondly, what we've seen is that 2 tools stand out as really important when it comes to help to drive non-state actors to net zero. It's transition plans on one hand that you were mentioning, Irene, and taxonomies that you mentioned. And they are both absolutely fundamental for transition finance and green finance as well, and they're 2 sides of the same coin, yeah? So if transition plans operates at entity level, the taxonomy helps bottom up. And what we've seen on transition plans, for example, is that 8 of the jurisdictions of the G20 require or encourage the development of transition plans, but only the EU, you know, not only mandates the disclosure transition plans, but also the implementation and adoption, you know, subject to the double materiality assessment. We're also, in terms of taxonomy, you mentioned it, it's very interesting when we published that report, we counted right before we published that report 50, now we know 60 are in the making, so clearly the taxonomy, is now covering more than 65% of the world's GDP. So very important instrument. Only China and the EU have some sort of mandatory, requirements for the time being attached to them, but it's very interesting to see how some of the big emerging markets like Brazil or Indonesia or, for example, Mexico are adding the special, real touch and particularities. No? So, for example, Brazil includes the management of soils and the management of, the use of soil, and the management of forest. Indonesia, very interesting, they include the just transition, or Mexico, social goals. So a lot, to be shared there in that space. Now, not all are good news. Not at all. I think that one of the bad news on the table, not surprising, is that these policies, the alignment of these policies when it comes to the global goal of limiting global temperatures to 1.5 is insufficient. Basically, what I mean by that is these policies are not sufficient to drive the necessary action, on non-state actors to reach net zero by 2050. What we also seen very interesting is that when you start looking at the details, they vary enormously, or in terms of scope, in terms of depth, but also in terms of ambition. Yeah, there's some areas that are underdeveloped. Not surprisingly, for example, the demand of, even in terms of disclosure of what is your strategy to phase out fossil fuels, that might, have a replication on, on the level, on the negotiations, or areas like on lobbying practices, yeah, which are very important. Two last comments, from my side. The fourth one is that when it comes to adaptation, nature and just transition, yes, there has been increasing consideration by policymakers, but it still are not systematically included in mitigation policies. Very interesting, particularly some emerging markets are leading in this area. And last but not least, what we're seeing is that when it comes to the do no significant harm, yeah, both in terms of social aspects but also environmental aspects, there's an increasing, incorporation in policies, but yet, a broader concept of justice, which is the right for sustainable development, it remains absent from the policies. So overall, progress made, but still a lot of work to be done, and great, potential for collaboration and learning and sharing.
It's a mixed picture indeed. I wanted to actually have a quick follow-up on something that we briefly discussed before this session as well, which is that I think the other piece of bad news, so to speak, is that I think we see increasingly some headwinds as well. So we see regulation picking up, imperfectly and patchy and still not ambitious enough. And at the same time, as I said earlier, many I think are overwhelmed and somewhat daunted. So what's the maybe starting with you, Philippe, but what's sort of the Swiss approach to dealing with or anticipating it even?
Yes, thanks a lot for inviting me. Really glad to be on the panel. I think that's really the relevant discussion at the moment. I mean, talking of tailwinds, we were of course also worried that, especially after the war in Ukraine started and all that, the policy mood might be shifting very heavily. We had very encouraging signals, albeit. So perhaps that in June 2023 we had a popular vote actually on the Climate Innovation Act, which was accepted with 60% of the population. So we're not talking about the hipster bubbles in Zurich or Geneva, right? So this is really very broad support for the net zero goal. To my knowledge, we're the only country that actually has a democratic mandate that was really very directly given, of course, in the parliament and so on that exists, but here it was actually a popular vote on the ground. This was really encouraging for us. I think the important point when we talk about implementation and actually making these policies concrete is that they need to be socially and economically viable to really be sustainable in the long term, right? I think the mechanisms that we have in Switzerland, they help us do that. So some people might have seen that we have started a public consultation on our ordinance on disclosures this Friday. So we actually want to implement minimum criteria for transition plans. So please comment, please let us know what you think about our project. Let's see that. And we also want to align what we're doing with the latest international developments. So I really think we have to think about this as a dynamic process. So we have to start doing things, we have to start getting disclosures, we have to start getting transition plans. They won't be perfect. We will receive them for this fiscal year now. I mean, it's quite obvious that they will be all over the place, right? But we have to build on that and improve. And talking about social and economic viability, I think proportionality is also an important point there. So you might know that we really insist, because our economy is also built on SMEs to a large part. So the regulatory burden needs to be reasonable. And I think having an exchange with the branches and with the companies actually on the ground is really important. I mean, still we have the strong mandate that we have to follow as a government, but also we need that dialogue. And we also work with voluntary instruments. So we have the very famous Swiss climate scores, of which we're very proud. So we developed a set of key indicators to just get a basic idea of what is actually needed to assess a company's portfolio pathway and so forth. So I think it's really about finding the right policy mix there. And this also goes for impact invested, and we're also working on blended finance. I mean, I really like the slide with, you know, the graduality of impact. And this is a reality, right? And you need disclosures and good quality data to actually give investors the chance to move into that graduality of impact. So it's all these things coming together, and just keep it proportionate, and then it's going to be sustainable.
Thanks a lot. So let's, I want to make sure we have a bit of time at the end for questions as well, but one round I wanted to make sure we do is on alignment and harmonization, which Krishnan already touched on in his first remarks. And I think that as we see this acceleration of policy tools, a deepening of policy and regulation, that also comes with a risk of fragmentation. This is a major pain point, I think, for the receivers of regulation and the users of taxonomies and other tools. And at the same time, I think policy and regulation has to be context specific, and countries have to address priorities and development needs locally. So yeah, maybe back over to you. Geetu, is how does this play out in India? How do you find a balance between being tuned into global conversations and still making sure that all the tools that you mentioned are fit for purpose in your local context?
Yeah, thank you, Laura. So I think I'll begin by addressing or highlighting the challenges which developing countries like India face in terms of putting in place regulatory frameworks which align with global standards, etc. So I think one thing, of course, which needs to be recognized is that developing countries like India have a huge sector, MSME sector, which is we have a huge dependence on the MSME sector, and they have their own set of challenges, and not all are able to integrate or align with the kind of frameworks in place. And therefore, we have come out with regulations, or I would say sustainability reporting, which is at present mandated only for the top 1,000 listed companies and not across, because I think it will be a phased manner in which we will make that happen. And secondly, I think developing countries, we of course, we need capital, we need resources from all sources. So of course, concessional capital is required. We also need a lot of private capital coming in. And while we emphasize on private capital mobilization, we see that developing countries, the private capital flowing into developing countries is still a trickle. And I think one of the reasons why that is so is also because of the stickiness and pro-cyclicality of sovereign ratings by the credit rating agencies, which was also mentioned earlier. But yes, I think there we need to address that so that more of private capital can come in, and all the industry, the stakeholders can better implement the sustainability standards and the sustainability frameworks in place. So I think what happens here is that developing countries lag behind the developed countries on several fronts. One, of course, is that there is need for investment in technology, capacity building, and research, and that because of the lag, I think that has also widened the North-South divide, and the Global South does confront significant development challenges, and therefore need to be provided with the space, the policy space and flexibility to tailor the frameworks, the regulatory frameworks and policies to the context and the needs, priorities, etc. of the developing countries. So I think that's how we have been designing our regulatory frameworks, and we have strengthened our position as a competitive player in the green economy by taking into account the domestic needs and priorities, while also aligning the sustainability policy and standards with the global norms. We have SEBI, who has recently revised the green debt securities to align with the updated green bond principles of ICMA. SEBI has also introduced a framework for social bonds, sustainability bonds, categorized as ESG debt securities. These efforts are all in line with international practices and aim to broaden the scope of sustainable finance in India's securities market so that we can ensure transparency aligned with international standards. And to conclude, I'd also like to emphasize the fact that networks and initiatives play a big role in bringing in the degree of alignment that is required in the approach towards risk management, taxonomies and standards. And of course, to cite examples, the Central Bank and Supervisors NGFS plays an important role and has essentially provided for exchange of experiences and sharing of best practices, and in initiatives like the Common Ground Taxonomy of EU and China, that has also supported an integration of global sustainable finance market. The inclusion of Singapore Asia taxonomy in the Common Ground Taxonomy is also a welcome step to promote regional economic cooperation and advance sustainability goals. I'll stop here, thank you.
Thanks so much, Geetu. We don't have much time, but I wanted to just hear everyone's thoughts as well on where we have G20 perspectives, European perspectives, UN DESA doing work on harmonization as well. Just want to give us your short 5 cents on the top 1 or 2 things that need to happen to drive this harmonization. Starting with you, Krishnan.
Sure, certainly. Thank you very much. I mean, for just following the negotiations at the UN, I mean, there are a few sort of important issues. I'll just touch on a couple of them, basically. First is the recognition that we need to have intermediate planning. I mean, you need intermediate steps. You can't go straight to zero carbon solutions. And for that, you need to construct appropriate taxonomies. It's extremely important there. And you also really need to sort of draw in also the private sector into this process across the investment chain, in fact, for which you need appropriate sustainable finance legislation, but also innovative mechanisms like blended finance and so forth. I mean, you correctly mentioned the point about, that on the one hand, it needs to be interoperable. On the other hand, it needs to be country specific. I mean, that's an important challenge, and that's an important realization that's come out of discussions at the UN. And finally, in fact, just the issue of, it was mentioned that, developing countries need to align with global standards set by ISSB, GRI, and so forth, for which you need data. You need a proper data infrastructure, and that is really one of the very important, some people would say it's a low-hanging fruit, but it's an extremely important one. Thank you.
The case of Switzerland is a bit particular, with Swiss companies being extremely kind of exposed to European markets around it. So what's your take, Philippe?
Yes, thanks. So we can sort of provide the other European perspective, so to speak. I mean, I would really underline that fragmentation is not only a risk, it's already a quite heavy burden at the moment, right? It's really an issue. And we have to strive for, of course, the global standards as the best and interoperability as the second best solution with regional standards and so forth. And let me really underline that I think the Swiss position is very clear that consistency and comparability is really the requirement to have any meaningful impact and actually be able to use data for structuring things. So that is really where we have to strive for. And I think it's also often overlooked that data also has to be accessible and actually discoverable. So what we're also supporting is work on data platforms. I can mention the NCDPU, where we really see a need to have a place where you can actually access data where it is more or less consistently held. And maybe just a last remark, I mean, it's also relevant for other areas in our responsibility. Financial stability was mentioned. So we also see the work done at the FSB, for example, in the Vulnerabilities and Data Committee. And I think the development of indicators that actually supervisory authorities can use, this is also extremely important thing. So once again, as global as possible, but interoperability will be necessary because we cannot just return what has been happening.
Helena, do you want to come in there?
Very quickly. So the task force, one of the main reasons why we, launched the task force was to help, to fix, if you wish, or to help collaboration between policymakers, to diminish, if you wish, that fragmentation that exists. Having said that, I want to add three, points very quickly that I think they're very important to keep in mind. The first one is that it's not, all this area is incredibly new, and that means that it is also new for policymakers, yeah? We are learning as we're doing. So part of that, of the intention of the platform is also to share the experiences, to really combine. I think that there's a lot of sharing that can be done that can help on reducing the fragmentation, yeah? So that's one point. The second point, a little bit more controversial, is, and you mentioned it, to strike the right balance between the serving the different realities of the different countries, and these are financial, but also economic and environmental. When you look at the taxonomy, you cannot think about having one taxonomy global, because biodiversity problems in Brazil have nothing to do with the biodiversity problems in Europe. But we're working towards, that compatibility. And I think that's the word that I like, is compatibility. We see it on the ISSB, we see it, through transition plans, task force, we see it on the common ground taxonomy. We need that. But it's also good to have certain jurisdictions to go farther, to really lift, because let's be honest, international standards are always the minimum common denominator. So let's not lose track on that. And the last one is that a lot of the work internationally has been done, focused on financial institutions, providing information to financial institutions. And yes, it's very important, but this is only part of the picture, Policymakers need that information. If you're a local authority, you need to know about the transition plans or the main companies operating in your region if you want to, for example, start thinking about what is the impact going to be in your community, how you are going to, transition. So let's move away of only financial institutions are the target. This is not about listed companies, private companies, state-owned companies also have to provide. And that brings me to the very last point, which is financial risk is super important, particularly for prudential regulation. But the impact risk is equally important. So the double materiality is fundamental, because financial risk is by far more subjective than, impact risk.
And on that note, I'm giving the final word to Irene. At the ECB, but also tune into NGFS, which in a way is a great success story, actually, of harmonization. But yeah, final thoughts from you, and then maybe we can get 5 minutes for Q&A.
Thanks. Yes, I see global convergence on 3 layers. That really helps. First of all, it's, I think, what UNEP FI does, also with the Net Zero Banking Alliance, to work together with the industry. So that's really the private sector. then I think the NGFS has really been a trailblazer. We are celebrating the 7th anniversary this month. And we started with 8 central banks 7 years ago. Now there are more than 144, so that's huge. And there, I think we've really, and I led the work on the first guide for supervisors. What can supervisors do to incorporate the risks in their supervision? We're up to like an assessment on the progress made, but I've seen the same structure being applied in South Africa, in Australia, and in other places in the world. So there, I think the NGFS is really the trailblazer. And then there are, of course, the standard-setting bodies. That's the ISSB, globally, the Financial Stability Board, the Basel Committee. So I really see these 3 layers: private, the banking and central banking, the central banking and the supervisors, and then the standard-setting bodies. On all these 3 levels, we need to advance, and to at least work towards a baseline on what we need on the standards, and then have it applied and further worked out in these other groups and in local jurisdictions again, apply it to what is needed. That's how we need to converge. And when I entered this building, I saw building bridges. Well, that's exactly what we need between all of this. And maybe this is also the time for Christmas wishes. I really hope for next year we can advance on transition plans, having a baseline on that and advance on that. And not only on the mitigation, also on adaptation and on nature. Thanks so much.
Thank you. And I'm getting a hard no, I think, on questions. But yeah, okay, I'm really sorry. We had a lot to say, but please find us during the coffee break. I think everyone's around to ask questions. Then thank you so much. And thanks everyone for listening and watching.